If you trade long enough, you will have a red month. That's normal. What isn't normal is what most traders do right after. Most traders won't be here in 2 years, not because they couldn't find entries, not because the market is manipulated, but because of one number they never calculated and one reaction they never prepared for. You've seen the screenshots, 90% win rates, account flips. I doubled this in a week. And if you've been around long enough, you've felt that pull. You've measured yourself against those numbers. Win rate, risk reward, monthly return. Let me say this clearly. None of those predict whether you survive. There is one metric that does: maximum drawdown. And not just the percentage on a spreadsheet, but how you behave when you're inside it. Slow down with me for a second. Maximum drawdown is simply the largest drop from a peak in your account to the lowest point before a new high is made. That's it. If your account goes from 10,000 to 20,000, then falls to 12, climbs to 25, and later drops to 10, your worst peak to valley decline was from 25 to 10, 60%. Now pause there. To recover from a 60% loss, you don't need 60%. You need 150% just to get back to even. A 50% drawdown needs 100% to recover. A 30% drawdown needs 43%. Losses are heavier than gains. The deeper the hole, the steeper the climb. And past a certain depth, most traders never climb out. Not because their strategy stopped working, because they did. Here's where people get misled. They compare returns. Strategy A made 40% last year. Strategy B made 25%. Most people choose A instantly. But what if strategy A had a 55% drawdown at some point during that year? At one moment, more than half the account was gone. Strategy B's worst drawdown? 8%. Which one could you actually hold without panicking? That's not a theoretical question. That's the real one. Because returns tell you what happened when conditions were favorable. Drawdown tells you what happened when conditions weren't. And conditions will not always be favorable. This is where most traders quietly break, not on a single catastrophic trade, but during a normal losing streak. 3 losses, 4, 5. Statistically, normal. Emotionally, destabilizing. The account drops 15% from the peak, then 20, maybe 25. At this point, something shifts internally. You start checking charts more often. You hesitate on valid setups, or you force trades that aren't there. You increase size to make it back. You widen stops for just this once. You override rules that were clear yesterday. Nothing dramatic happens, just small decisions made under pressure. That's the collapse. The drawdown didn't destroy the account. The reaction did. And here's the core problem. Most traders design strategies for profit. Almost none design for psychological survival. They optimize entries, they optimize exits, they backtest for returns, but they never ask, what is the worst stretch I can endure without changing who I am as a trader? Because that number exists, and it's usually lower than you think. There are 2 layers to it. Financial tolerance. How much of this capital can you lose without affecting your real life? If this money pays bills, if it carries emotional weight, your tolerance shrinks instantly, whether you admit it or not. Then there's emotional tolerance. Think back to your worst losing streak. Did you lose sleep? Did you feel urgency to do something? Did you start questioning setups you would normally take without hesitation? That's data. That's your nervous system telling you where your limit actually is. Not the number you say out loud, the number you feel. Once you see that, things get clearer. You don't need the highest win rate. You need a survivable system. That means defining a maximum drawdown limit in advance. 10%, 15, 20.
The exact number doesn't matter to anyone else, it matters to you. Then you build around it. Position size small enough that a normal losing streak doesn't immediately threaten that limit. If you risk 1% per trade, you would need 20 consecutive full losses to hit 20%. That's rare. That buys stability. Then you create trigger rules. At half your limit, reduce size. At 3/4, pause and review every trade. At the full limit, stop trading completely for a defined period. No debate, no emotion-based exceptions. Because when you're inside drawdown, you are not objective, and expecting yourself to be is unrealistic. The traders who last understand this. They don't try to eliminate drawdown, they design around it. They assume losing streaks will happen. They expect underperformance phases. They plan for their own psychological weakness instead of pretending it doesn't exist. That's the difference. Not intelligence, not secret strategies, stability. Here's the quiet truth about survival in trading. It isn't impressive. It's not the 100% month. It's not the viral screenshot. It's the 8% drawdown when others are down 30. It's the position size you didn't double. It's the 2-week pause you actually respected. You cannot compound from zero. You cannot recover from ruin. Every blown account follows the same structure: undefined drawdown, emotional reaction, rule breaking, acceleration of loss. Maximum drawdown is not just a statistic in a report. It is the clearest signal of whether your strategy is built to last and whether you are. So here's a simple exercise. If your account dropped 20% starting tomorrow, exactly 20, what would you do? Not emotionally, specifically. Would you reduce size? Would you stop trading? For how long? If you don't have a clear answer, that's the gap, and that gap is what removes traders from the market. Survival is not dramatic. It's controlled, measured, predefined. You choose your number. You respect it. You let that rule outrank your emotions. Do that, and something shifts. You stop chasing high returns. You start protecting longevity. And longevity, quietly, is the only edge that compounds. Most traders try to win big. The ones who last focus on not disappearing. That's the metric that predicts survival.